The Property Bulletin by London Property, the home of superprime.
London's reputation has taken a hit lately. Tales of watch thefts and nervous tourists have overshadowed the city's strengths. But James Rayner, the man overseeing the Duke of Westminster's £10.5 billion Grosvenor property empire, insists the capital's future is bright. Rayner, recently promoted to chief executive of Grosvenor's global property arm, admits he's experienced London's challenges firsthand. He had his phone stolen on Regent Street earlier this year. But he's quick to defend the city's resilience. We talk endlessly about the negatives, he says. What about the fact we're adding 80 new police to the West End? There's a lot to be positive about. Grosvenor's plans are proof of that optimism. The estate will invest £1.5 billion in London by 2035, revamping landmarks such as the Barley Mow, the Audley and the Running Horse, as well as redeveloping South Molton Lane with new shops, homes and public spaces. The firm is also funding the largest private green space investment in the West End for a generation at Grosvenor Square, complete with wetlands and 70,000 new plants. Rayner's strategy is about reinvention. From flexible offices designed for post-pandemic work to more affordable homes in Mayfair, he's determined to make the area vibrant and accessible, not just a monopoly board address. He's also vocal on policy, critical of scrapping VAT-free shopping for tourists. Despite falling foreign investment, Rayner points to Grosvenor's recent £306 million deal with Norway's sovereign wealth fund as a vote of confidence. London creates the surplus the UK lives off, he adds. We should be proud of it, not apologising for it. The position of freeholders in England's property market has taken a seismic hit. A £5 million High Court challenge to the Leasehold and Freehold Reform Act has failed. In a 167-page judgment spanning 558 paragraphs, two judges rejected every element of the freeholders' human rights claim. The court ruled that Parliament was fully entitled to rebalance property ownership in favour of leaseholders, even at the expense of landlords' rights. The verdict removes lucrative freeholder advantages such as marriage value, uncapped ground rents and legal fee recovery. While the appeal wheels may still turn, the era of ground rent gains and one-sided lease extensions may well be drawing to a close. What comes next could define the future of property ownership in England and Wales. Once the ultimate trophy home, 2 to 8A Rutland Gate, a 45-room, 62,000-square-foot mansion overlooking Hyde Park, now sits frozen by court order and is slipping into disrepair. The shell was bought for a record £210 million in 2020 by a vehicle linked to Hui Ka Yan of Evergrande. It later emerged the legal owner is his wife Ding Yu Mei. As Evergrande imploded, liquidators alleged misappropriated funds and won a freezing injunction, stalling a planned resale reportedly guided around £250 million. So what to take from this affair? Legal wrangling over Evergrande funds has locked the house, halting any sale. The prime London market is softer. Higher stamp duty, stricter AML checks, non-dom changes and shifting global wealth flows. Even at a discount £100 million, stamp duty, £1,000 per square foot, build costs and finance costs can push total outlay over £230 million. On a busy road, there's limited privacy, making the property better suited to a hotel, office or embassy than a single residence. From Middle Eastern and Russian buyers to Chinese capital, London's superprime era is recalibrating. Built as 4 houses, rebuilt in the 1980s into one mega mansion, Rutland Gate passed from Rafiq Hariri to Saudi royalty before the 2020 record sale. Grand redevelopment plans, spa, Olympic-length pool, underground garage, never started. With Hui detained in China and creditors circling, liquidators targeted family assets abroad. Agents were warned off marketing. On the ground, locals now see a dark, empty facade, sometimes even a rough sleeper on the portico, underscoring the gap between paper wealth and real-world utility. Unless a commercial or sovereign buyer steps in, or a legal settlement frees the title, the building risks further decay. Developers face punishing entry costs, buyers face tighter scrutiny and less tax advantage. London's superprime won't vanish, but the era of frictionless statement buyers looks over. For years, property sustainability meant trimming energy bills, efficient lighting, better insulation, smart HVAC. But the next frontier in real estate's climate transition is even more invisible, so-called embodied carbon, the emissions baked into steel, glass and concrete long before a building opens its doors. As the sector chases unlikely net zero targets, the focus is shifting from Scope 1 and 2 emissions to Scope 3, the upstream carbon in construction materials. Understanding embodied carbon is really challenging, but it's the only way to know if a building is truly net zero, says Brianna Wheeler, US Operations Director at BREEAM. Version 7 of BREEAM certification pushes this further, rewarding whole-life carbon analysis, materials transparency and design for reuse. It encourages viewing each building as a materials bank, a store of components to be reclaimed, not discarded. With material costs soaring, circular design now carries real financial weight. For decades, embodied carbon was a black box. That's changing. Environmental product declarations and digital tracking tools now make Scope 3 emissions measurable and auditable, exactly the assurance investors and insurers demand. Even without US policy pressure, sustainability is becoming a business advantage. Buildings with lower embodied carbon risk enjoy more stable operating costs, better insurance terms and higher liquidity. Some tenants now request full carbon disclosure in ESG reporting, proof that the shift is market-led, not regulatory. While the SEC has softened its stance on Scope 3 rules, global investors are already pricing embodied carbon as a financial risk. The industry is learning that sustainability isn't just about how a building operates, but how it's made, and what happens when it's torn down. The green story started with counting kilowatts. It's ending with counting tons of steel and concrete. The next phase of real estate sustainability is about what goes into a building, because managing that is what will truly determine the industry's carbon future.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.